Refund anticipation loan is a short-term consumer loan in the United States provided by a third party against an expected tax refund for the duration it takes the tax authority to pay the refund. The loan term was usually about 2 to 3 weeks, related to the time it took the U.S. Internal Revenue Service to deposit refunds in electronic accounts. The loans were designed to make the refund available in as little as 24 hours. They were secured by a taxpayer's expected tax refund, and designed to offer customers quicker access to funds. The cost to the borrower could be significant compared to other lending, and some consumer organizations warned consumers of the risk involved in this type of loan. They are largely discontinued financial products, and beginning with the 2013 tax filing season, they have been largely replaced with the similar refund anticipation checks, as well as a hodgepodge of other financial products. RACs are temporary accounts which wait for the client's IRS tax refund, and which also provides a way for the client to pay for tax preparation out of the refund. Both financial products have similar fees and similar risks. A third-party bank cross-collection. A similar process in Canada to a RAL is termed tax rebate discounting. United States. In the United States prior to the 2013 tax filing season, taxpayers could apply for a refund anticipation loan through a paid professional tax preparation service, where a fee is typically charged for the preparation of the tax return. In the United States, the Internal Revenue Service rules prohibit basing this fee on the amount of the expected refund. An additional fee was usually charged for the services of originating a bank product and establishing a short-term bank account. By law, this fee must be the same on both loan and non-loan bank products, and in 2004 the average fee was $32. The bank through which the loan was made charges finance charges. According to the National Consumer Law Center, 12 million taxpayers used a RAL in 2004. With e-filing and IRS partnerships that help consumers e-file for free, U.S. taxpayers can generally receive their tax refunds within 3 weeks, and sometimes as quickly as 10 to 14 days if they choose to receive their refund via direct deposit. This rendered RALs less attractive to some. History. RALs began in the 1980s when the IRS introduced electronic filing as a way to decrease its cost of operation. A tax preparer would, within 24 hours of submission, receive from the IRS confirmation that the submission was free of mathematical errors, and that the filer had no liens or delinquent federal student loans. This meant that there was good chance that the IRS would pay the refund within weeks, barring fraudulent income reporting. At that point, the preparer would issue the filer a check for the amount of the expected refund minus a commission. In 1995, the New York Times reported that beneficials' $30 electronic filing fee and $59 loan fee amounted to a 250% APR on a refund of $1,000. Exploitation of the system had begun by the early 1990s. Filers misreported their income to inflate their refund. As a result of this, and also to discourage filers from this rather uneconomical offer, in 1994 the IRS stopped providing tax preparers a confirmation that a deposit would take place for a certain amount and that it would begin sending refunds directly to taxpayers instead of banks that made the loan. But not having the desired effects, the confirmations were reinstated the following year. Controversy. According to the Consumer Federation of America and the National Consumer Law Center, RALs are controversial because, like payday loans and title loans, RALs are high-profit, low-risk loans marketed toward the working poor. A 2006 study by the NCLC and the Consumer Federation of America found that, based upon the prices for RALs in 2006, a consumer can expect to pay about $100 in order to get a RAL for the average refund of about $2,150 from a commercial tax preparation chain. This year. Opponents of RALs, like the National Consumer Law Center, argue that the profit motive of the lender results in RALs being issued too often to low-income individuals who are made to believe the wait for their refund is longer than it really is, who do not realize they're taking a loan, do not understand the high interest rates charged by the loan, and who do not actually need the funds immediately. Third-party cross-collection of bank debt for both RALs and RACs. As part of applying for both financial products, the client is directing his or her refund to the account-issuing bank. Cross-collection occurs in cases where the bank uses this occasion to collect debt owed another bank. As the IRS taxpayer advocate described the practice in 2006, if a taxpayer owes money on a defaulted RAL to Bank A and subsequently attempts to buy another RAL from Bank B, Bank B is authorized to collect the outstanding debt from the RAL proceeds, transmit the funds to Bank A. It is somewhat unclear how broad is the type of debt for which banks cross-collect. This practice is often not adequately disclosed to the tax preparation client. As a lawsuit filing against H&R Block by the California Attorney General in February 2006 stated, H&R Block does not adequately tell such customers about any alleged debts, or that when they sign the new RAL application, they agree to automatic debt collection, including collection on alleged RAL-related debts from other tax preparers or banks. These applications are denied, and the customer's anticipated refund is used to pay off the debt, plus a fee. Tax prep firms often vaguely refer to this practice merely as previous debt. This risk exists even if the client is only using the RAC account for purposes of taking the tax preparation fees out of the refund. Yan, 2011. IRS will not be providing debt indicator. On August 5, 2010, the IRS announced that for the upcoming 2011 tax filing season, the agency would no longer be providing preparers and associated financial institutions with the debt indicator. Taxpayers themselves will continue to have access to information about their refund through the "Where's My Refund?" feature at the IRS.gov website. In the same news release, the IRS stated it was exploring ways to allow filers to directly split off part of the refund to pay for professional tax preparation, possibly starting in January 2012. The IRS is asking for input from filers, consumer advocates, and those in the tax preparation community regarding whether this would be cost-effective. Yan, 2013. Major U.S. banks stop offering RALs. Beginning with the 2013 tax season, major U.S. banks will no longer be offering RALs. They will instead be offering the similar financial products of RACs, which are not loans but are rather temporary accounts which sit empty waiting for the client's IRS refund. Articles. Republic Bank's refund loans challenged. Louisville Courier-Journal. December 16, 2008. The threat to a lender of last resort. Smart Money. November 13, 2008. Instant refunds no bargain. Chicago Tribune. March 16, 2008. http://www.usa.com/money/pfi/general/2006-09-17-refund-loans-use_x.htm. E-filing can make high-fee loans unnecessary. MSNBC, the 15th of February 2006.